Good morning, ladies and gentlemen. Well, this weekend little war between Israel and the Palestinians is making me rethink what I can tell you this week. Not that much, but slightly. What is important here is that the risk dial is still very much positive and indicating a huge preference for equities over fixed income, and that is not changing. One thing I have to say, because I've been asked many times, is that daily changes in the score have absolutely no predictive power as to what is going to happen day to day. They just indicate the longer term trend that assets are in. So absolutely disregard falls by 10, 15, 20 points and then rises of 10, 15, 20 points. It is absolutely immaterial to the longer term trend. Let's have a look at what bonds are doing and what they are predicting for other asset categories. I think what you have to bear in mind is that wars are always inflationary. This is not a big war. What happens in Israel and between Israel and the Palestinians has really never affected macro and longer term outlooks. If it does affect it, it will be on an inflationary way, just like when war broke out between Russia and Ukraine. You had a flight to safety, which was very quickly unwound within days. You will have the same thing here, because it just goes to, it's just logic that bonds are going to get hit because of both the inflationary potential of higher oil prices if they materialize, and also the fact that more deficit spending is going to be necessary. So I really don't think that this marks any kind of reversal of current trends. Next week we have significant amounts of supply, 3s, 10s and 30s, and the yield curve really couldn't be any clearer. It is in a period of steepening, bear steepening at that. So really 2s, 10s after 16, there is very little to hold it until we get to these levels around minus 16. So that is another 25, 30 basis points of steepening. And if we look at the 5s, 30s, that really beyond the lows that we had here around minus 40 has nothing to look forward to. It's basically just saying that this becomes an island that we break through and then we go quite a bit lower. So the yield curve says it all. We are in a period of steepening and there is nothing but steepening to look forward to. Any kind of retracement, especially on these news about Israel, is going to get sold. I don't think we're going to get any retracement at all. I think it's actually going to exacerbate the move. I really next week at the open would not sell it below this minus 30 level, because I think it's probably overextended for the time being, but the direction cannot be doubted. The response to NFP on Friday was very interesting, insofar as I think that the market is saying that the move at the back end of bonds is actually a tightening of financial conditions, which means that the Fed can continue to do nothing. It is extremely unlikely, I think, especially given what's happened over the weekend, that the Fed will hike unless CPI is a real surprise. And we have CPI as well. And on the day that we get the 30s auction too. So I think that is what the market is saying. The market is saying that we are not going to get anything from the Fed, in which case the twos are stuck between 4.99 and 5.27. And that is basically what I've been saying for a long time, that the market just wedges slowly upwards and tries to build in this final rate hike that we might get this year. We might not get it. It might be enough to be where we are. We shall see what the numbers are, but data has to be very surprising on the inflation side to immediately build in another hike from the Fed. We will see what CPI is, but if it's not that high, I think the twos remain in this range and really trade around this 5% area. While there might be a little bit of flight to safety on the open in twos and fives, I doubt there's going to be very much in tens and 30s. So, again, steepening. Fives might come back down to here, 461, 463, but I don't think they go any further. Tens are going to have even less. They've reached this 482 level. They might come down to around here, 465, something like that. But I think they are definitely going to go and test 482 at some stage during the week again. And 30s, I mean, they've gone straight through this 472 area, which really surprised me that they didn't even hang around. But if you look at what the weeklies say for the 30s, you will see that there's very little now until this kind of area, and we're talking about 5.25. So you're gonna get volatility on the open, but there's going to be very little flight to safety in the long end. There might be some in the short end, but I think the path of least resistance is going to be to sell the open, or sell tomorrow morning once all the sort of headless chickens have bought, because I think tens and 30s are immediately heading upwards. And let's have a word about why they will not have a lot of flight to safety. Okay, this is inflation expectations, 5-year forward, and they are relatively stable, right? They're within a 10, 15, 20 basis point range, and they are not moving. What is moving is the term premium, and the term premium is going positive. Why is the term premium going positive? It's going positive because of the potential expectations from another QRA coming in the first days of November, where the market could easily be faced with an additional, and I stress additional, because we already know that we are going to get something like 350 billion in issuance, and we could get another 150 billion on top of that. So I think term premium is going to continue to go into positive territory, which basically exacerbates the steepening, exacerbates real rates. I think real rates, which I'm going to show you now, are very attractive, but I think they're not going to come down. They are what I would term an investment level. I actually traded them at 255 on Friday. This is still from October the 5th. They haven't updated it. So I think the odds that any kind of flight to safety can be in the long end is fanciful. I think at best you get some flight to safety in the very short end, and term premia and continue to rise because of the fear of even more supply being announced in November. But real rates, really somewhere around these levels of 260, 270, should be topping. So as an investment, 10 years are becoming attractive. For a very long-term investor like myself, I think holding at 255 in reals is an attractive proposition because we haven't really been any higher since, well, for 2 decades and more. And really the only time we were higher was back in the 80s and 90s, which I think were completely different periods in terms of potential growth of the economy. So I would tend to disregard those. But what all the combination of all this tells me is that the long end is going to remain heavy, whatever happens, and that really steepening is what you're looking for. And also potentially people investing in reals when they start getting up towards 255, 275 area, but also that term premia are going to continue to rise. Everything I've told you is really encapsulated very well by this BlackRock report, which has just come out. And basically they're telling you the same thing as me. Prefer the UK and Germany over the US. And really, prefer emerging market bonds in US dollars over USTs, and they prefer short-term government bonds over long-term government bonds. And also you will see that they prefer, I will come down to it in a second, in fixed income. This is the page that we like: short over long, and US inflation-linked bonds over anything else. So that makes perfect sense to me. It's everything that I'm looking for: a steeper curve. I'm looking for Europe to outperform the US. Within Europe, I'm looking for less issuance countries over large issuance countries, so bonds over BTP. And I'm looking for US inflation-linked bonds to do better than nominals. Not that much better, because it's going to take a long time for that trend. But we are getting to investable levels for the very long term in US inflation-linked bonds. If we look at the German yield curve, this is 2s10s, same tendency, but with a lot less impulsion than the US. I think they are 3-6 months behind. So I really would not be surprised to see a range trade here in 2s10s or even in 2s30s. I think it's unlikely that we come down very much. We might bounce a little, and then in 2 or 3 months' time, we will continue that trend. So I think a lot less steepening in Europe, and that makes everything else basically attractive in terms of playing Europe against the US. I might have had a stroke of luck on Friday getting out of my 10s US Germany, because any kind of flight to safety might knock us back down towards this 182 level. But I think it's another buy. I think that it's going to trade this 202 area. It's going to be tough to break through there, but I think it's going to trade there. That's the natural tendency for this. And really, you can even think of something like 2s Germany against 10s in the US, or 30s US against Germany. I think the likelihood of this on a pullback to 172, which we might easily get on Monday or Tuesday, some stupidity of coming back down, I think it's going to trade this 192 to 201 area. especially given that we might get this QRA in early November showing an additional 150 billion of long-term bonds that need to be issued in Q1, in which case the market will definitely start trading around these levels, 201 of 30s. So it's a continuation trade, and if we get a stupidity flight to safety by US, that kind of stuff, you want to load the boat again. This is now Bunds BTP. We've closed really at the highs of the year. I think there's very little likelihood that we don't trade 216 at the very least, and 227 could be, the spike. Again, same reasons. Germany is going to be issuing the least, and the supply is just going to kill Italy relative to Germany. Any kind of pullback down towards this kind of level, 197 now, is where I put the trade on again. Add to it, I got out 90% here, but I'm regretting it really. So any kind of a pullback, I'm going to put this trade on. And if we look at the butterfly between Bunds in the middle and Italy and US on the outside, I got in about there. I still think I'm out 90%, and I don't know why. I think any kind of move back up towards 375, 370, 376 is an opportunity to put it on again. It's definitely going to 406, and quite possibly on an overshoot is going to, around this, 427. So that is another 30 basis points from where we are, and potentially 40 basis points from where we could put it back on. These are the natural moves that will persist in time, regardless of some short-term flight to safety on some silly little conflict. The Dixie really behaved exactly as I expected last week. Some strength, some weakness. I think at these levels, regardless of some silly little conflict, it's not a great risk reward to buy it, especially if it gaps up and opens around 106.80 or something like that. To me, that is, the risk reward is just non-existent. You might make 20, 30 ticks and lose 150. So I prefer to remain neutral. You can't really be bearish of the Dixie, but you can be neutral and say that, okay, we've gone a long way in differentials. We will go further, but maybe it's time to step aside and let it do its own thing for a few weeks. Let it go sideways and then recharge and have the strength to go up again. I just think that buying it up here is very bad risk reward, especially on a spike higher. And, you can see these levels in Euro USD, they've always been very significant. This 104.38, and every time it's gone here, it's bounced, and it's always bounced to this kind of level, 107.08, 107.10. And I think, it might try it again, but I think the natural tendency will be to hold in. And while it does that, I don't think that the dollar can really move very much. So that's my view for what it's worth. I'm not going to be selling dollars. I'm not going to be buying them either. I'm going to wait to get a much better risk reward area, which is somewhere in the high 106s or very low 107s. There, I definitely will be a seller of euros and a buyer of dollars, because I think that level makes a lot of sense on a risk reward basis. because I think the inflation differentials are going to move out. I think the bonds are going to keep on going in terms of differentials, and that level makes risk reward sense to me. Current levels, not so much. I actually added to gold below 1830 on Friday. Might have got lucky, but really, when you look at, we're through the weekly Bollinger Bands. We've been weak all week on the back of the bonds and so on. But gold is a reals play as opposed to a nominal bond play. And I invested in reals on Friday. I invested in gold and I invested in QQQ. So, what do I think gold does? Well, it could easily do one of these and bounce to this kind of area, just short of 1900, or maybe do a little bit better to 1920. Do I think it's going to go higher? No, I don't. So that is all I'm looking for in gold. And if I see 1900 or very close to it on Monday, I'm selling it. I'm selling my longs. Absolutely no reason that I can see that it's going to trade through there. Might do because some people are short, who knows. But if I see it up there, I'm a seller. I think it's probably going to be too early next week for oil to have an outsized move, because we just don't know what the implications of this conflict are. They could be very, very regional. I mean, they're not oil producers, are they, Israel and Palestine? So unless this conflict goes way beyond what it is now and goes into an Arab-Israeli type conflict, then, which is unlikely, because let's face it, this is the Iranians trying to, put to spoil the relationship that Israel is building with the Arabs, and then the US is negotiating, the one that I tweeted you about Saudi Arabia, mutual recognition, let's go forward and stuff like that. So it's unlikely that the Saudis are going to have an outsized response. So what could you look for? You could look for a move to 87, 88 quite easily. But I think that caps it, and that oil remains in a downtrend for now. I just don't see that being anything but, an opportunity to sell even oil at those levels. And if we look at DBC, what it did last week, it's basically saying that it doesn't want to make new highs for the year. It came back hard. So I would have thought that, moves back to these kind of levels, 24.57 to 24.67 is going to cap it. A lot of people are going to be happy to get out there, or to be able to get out there. And then I think that we remain in a range. I think these Bollinger Bands closing is probably as, correct, i.e. more ranging in this kind of area. Every time war comes up, ETA becomes interesting. So we haven't looked at it in a long, long time. We got out so close to the top, it's not even funny. And since then, it's come off, what, a good 10%, right? Is it looking attractive? Nah. We had a bit of an outside day reversal on Friday, which I didn't really even look at. What do I think? I think 107.93 trades. Let's see where it opens on Monday. You might want to, if it's only like 105, you might have a couple of percent there. But certainly against the SPY, it's not looking unattractive at these levels. Look where we are. We are at levels which always supported it before, and where you've always said a 5, 6, 7, even 10% relative correction between ETA and SPY. So keep that one in mind for Monday. If it only opens up 1 or 2%, it's a buy. It's certainly on a spread to SPY. If we look at SPX, it's obvious that really it does not want to go down. Every time we've tried this, these levels, it's just bounced like crazy. Friday might have been a bit of an outlier because there was a squeeze on, but the squeeze was in NASDAQ for obvious reasons, because if you are putting money to work like I am in reals, then NASDAQ can scream higher. Because if reals aren't going to go any higher, or maybe 10 basis points higher, which NASDAQ really isn't going to care much about, then it's time to buy those high duration stocks. The low duration stocks and the defensive ones aren't really going to move very much either way, so it makes sense to buy NASDAQ over SPX. But if even SPX can't go any lower than this, and okay, might open, I don't know, 20 points, 30 points lower on a knee jerk, I think that's a buy, or you buy call spreads, or you sell puts, because I think the likelihood of SPX going down below 42.50 without data and staying there, I think are very low at the moment. Well, NDX was really the story last week. The fact that it just wouldn't break this 14,575 area, just would not, tells me that it's trying to base here. And that, as I've said, makes sense to me with the reals where they are. This is the 195 minute. This is not showing much potential upside in the very short term, or in the next 2 or 3 days, which is exactly what I expect, because it'll probably come slightly back on the war news, like knee jerk, but it's not going to go very far, and it's just going to stay there, open up the Bollinger Bands, and then do a move up to these kind of levels. I would have thought 15,450-ish, that kind of area. It's going to get everybody bullsed up, and then we see. Because I think that by then we will get the new QRA, and that might knock it back down. But at the moment, I don't see anything but upside in NQ from lower levels where it might open on this knee jerk. The one that's becoming interesting to me is Nikkei. I think that this was such a classic touch and bounce that if we get the knee jerk down, because let's face it, Japan should suffer most from higher oil prices, etc., etc. It's all not all that important where oil prices are for a week or two. If we get a move back down on Monday and Tuesday in Japan, I think it's an opportunity to buy some calls. Anything around 30,700, 30,800, I think is going to be a great opportunity. On the weeklies, I think, even 31,000, 30,900, I think I'm definitely buying calls. And finally, something that I'll be looking for on Monday. If the VIX cannot make new highs, I think that is your signal to buy call spreads in all equities, and even 1x2s. Very short-term 1x2s, struck far enough, like 2-3% higher, something that expires on Wednesday or something like that, because you're going to get a big squeeze in equities from that drop. But I'll tweet you that on Monday. I've changed all the important levels. I think the opportunities are going to be in selling gold at higher levels. And I think the opportunities are going to be in buying the dips, especially in the NASDAQ. And we will be looking at this 2060 level in the VIX. If the cash VIX can't open there or stay above there, I think it's your signal to buy all equities. And I would have thought that the Nikkei will be a good one, and I would have thought the NDX is going to be an even better one. That is all I have to say for this week. I've included here a link to that BlackRock report, an outlook which I think is spot on longer term. And on Monday, basically, we concentrate on selling the flight to safety knee-jerk reactions and looking for buy spots on equities. Thank you very much indeed. Have a lovely weekend.